Hi everyone, welcome to this live show. As usual, my pleasure to be here with you to share my views on the market. We are going to review the macroeconomic calendar as usual and charts, but keep in mind we are in the last 2 weeks of the month. Volumes are low. The North Hemisphere is on holidays, and the major events of the year are behind us already, right? So, anyway, I was watching the macroeconomic calendar earlier today, and I was pretty disappointed of what we have ahead because we have not much triggers, not many triggers ahead in the US, right? The calendar is pretty light, and in fact, we had a couple of interesting things going on this week, but the market has shown little reaction to news and kept on buying the greenback. Seems the enthusiasm following Fed's announcement it remains alive. I guess this enthusiasm is also based on hopes Donald Trump would bring grow on inflation to the US. But anyway, what I would like to mention, what I was figuring out before starting the webinar is German data, right? We have the IFO survey yesterday was pretty encouraging, highest in a couple of years, showing that local confidence among business is strong. We also had today producers price index positives figures also I believe that it was the first time this year we have the year-on-year figure above zero in positive territory. So overall, seems that despite the euro area may be in trouble and inflation is not moving as fast as it does, as it as the ECB wants. Sorry, at least Germany is doing good. It's showing some signs of growth, accelerating over this last quarter of the year, and therefore somehow it's supportive, right, of the euro currency. Uh, despite the pairs trading, the euro dollar is now trading at 14 years lows. Anyway, as I was saying, the other important event, sorry, I forgot to mention, was the Bank of Japan. Not much to see there. They left their economic policy on hold. My take is that they will probably be waiting to see what's next with Donald Trump in January after he takes the office by the end of January, and the infamous 100 first days, whether he will apply or not, everything that he promised, infrastructure investment, tax cuts, and so on, right? That will probably help the yen depreciate further and therefore take most of the weight out of Bank of Japan shoulders. Okay. Anyway, and moving forward, give me a second. Sorry. Sorry for that. Give me a second. Sorry. Anyway, back to what I was saying. I was checking the calendar, and for tomorrow, the fact is that I believe that the only relevant figure we have is existing home sales in the US. We had sort of a disappointment from the housing sector late last week, right? Housing starts and building permits plummet after a strong rise in October. As I always said, one bad reading it's not enough, right? As this, it's not one positive one to measure the health of a certain sector in a certain country. But if this one is also negative, the market will take their chances to take profits out of the table of recent dollar gains. And therefore, the market reaction could be a bit larger than usual, right, to a negative number in existing home sales. And by the case, to any US figure to be released over the upcoming days. Nevertheless, I believe that Thursday personal income, core personal income consumption expenditures are much more relevant, right? And the second revision, if I'm not wrong, of US GDP will be much more interesting than any other number. I'm not expecting much of a surprise coming in here, durable goods will probably be more relevant than GDP on 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 Thursday. Sorry, because this is a revision, right? The final revision, if I'm not wrong, third revision of the figure. While this is a new one, expected negative, another reason to take profits out of the table. And finally, and for Friday, I don't believe that there's much to watch except for the Michigan report and the housing data. Sorry, and for the sentiment is strong. If it picks up, it will probably neutralize any negative effects we have from housing reports. Okay, but if we had a bad reading here, a bad reading today, added to the bad reading we have last week, it would indeed prevent the dollar from rising much more higher. Okay. Anyway, let me change a bit and go to charts, which are as usual far more interesting for me. I hope for you too than whatever happens in macroeconomic calendar. Anyway, let's go to see our friend Euro, which is trading a few pips above the 14, almost 14-year lows post last week at 1.0366 for me. I was watching the pair and thinking about all the political developments we had this year and the ones that are coming, right? And to be honest, I can see a reason for the euro to strengthen beyond some profit takings or corrective movements towards the upside. I believe that the pair is still bearish. That a break below that 360 will probably end up in the short term taking us down to 320, but getting closer to 200, 206, if I'm not wrong, is February, not sorry, July 2002 monthly high for the euro dollar. So that's the level I'm targeting these days. And for corrective movements, I will see in this forward charts, ever since the week started, the 20 simple moving average has been the selling level, right? The resistance is capping the upside today around 425. So this is my immediate resistance. If somehow the pair manages to break above this level, it can go up to 470, 480, which is this week high, and even higher up to 520, 30 region, where I do expect selling interest to resume. I don't see corrective movements beyond this 520 right now, but if they happen, they will be more intense, and we will probably see the pair returning to the 600, 660 price zone, which is for me the tops hardly possible to reach, but well, probably top, and the pair can reach, can go, sorry, and strong profit taking probably more next week than this one. Um, Keep in mind that volumes are really low, as I said earlier, that we may see mayors moving between 20, 30 pips for hours and hours, and all of a sudden, out of the bloom, there goes the movement of 50 pips in one way or the other with no certain catalyst, and then again back to the consolidating the 22 pips range. That goes not only for the euro but for all mayors, and that's what usually happens in this time of the year when volumes are extreme low and we have some orders, big orders, not that big, right? But given the low volumes we have, so our big orders coming from banks. So don't expect those movements to persist, right? Unless they are triggered by some profit taking following the release of some fundamental news. Okay, that goes for the euro. Anyway, I will jump to the pound. Uh, all of the rally we had on hopes that the Brexit won't be a hard one, but a soft one, sorry, were trimmed right after the Fed, right, with the pair plummeting to a fresh December low, of 23.76. After that, there was still confidence in the pound, and therefore we saw an upward corrective movement towards 25. But the pair wasn't able to regain it because all of a sudden we are having um, Scotland messing in the way. Scotland has said that it will probably do another referendum about remaining within the euro area. Sorry, within the UK, right? Because they want to remain in the single market, in the European single market. Sorry, I'm getting interrupted, and it's terrible. Uh, Anyway, what I was trying to say is that Brexit concerns and the possibility of a hard Brexit and Scotland separating itself from the United Kingdom has put the pair back under setting pressure. I have a huge support right in the 2330 region. If you remember, the level has capped the rally for most of October and a bit of the first half of November, if I'm not wrong. It was the line in the sun for bears, and now it seems to be the line in the sun for bulls. If the pair breaks below that level that it has already tested today, there's a good chance that we will approach back to the 120, 121 region uh, before the year is over. Okay, a week and a half. So I'm watching mostly this particular level because I do believe that pair has scope to extend its light once below it. Uh, Mostly because we are seeing a lot of demand of greenback, and and that will probably persist during the upcoming days. Okay. Furthermore, the pound is a bit of delayed compared to other majors when talking about multi-years lows or multi-months dollar highs after the Fed, right? So beware of that level. 2330 is for me the key. What I was also watching today is that selling interest has been capping the upside on attempts to recover the 24 level, as it has previously on attempts to recover 125. So unless we see some follow through beyond 24.25, I do believe it's the high we set yesterday. Yeah. And then probably we will see selling interest on spikes rather than an upward corrective movement. Not seeing uh, much market interest today in going against the greenback, but the other way around, right? Uh, Another thing that seems quite interesting these days is just remember it has broken to multi-year lows. Let me put the weekly chart on. There we are. This is the year rally. We have been consolidating between those Fibonacci levels ever since late May, right? When we test the 61, and there we go. And the pair broke lower. The 61.8% retracement of that EUR rally. It stands at 72.10, in fact, and we are getting pretty close to that. Have some EUR lows around monthly lows, sorry, around 71.15. So if we take down 70 to 10, then my next target comes at 71.15, and the probable bearish low for the upcoming days. Okay. Uh, the OC, right, has benefit before this latest decline in post US election, post Fed, has benefit from the rate differentials, right? Despite the US has hiked its rates, we are still at 0.50, 0.75, and Australia, which is at record lows, is at 1.5, okay, over the double. So that was what kept the Aussie dollar pair holding above 74, 75. But what happened here? Why this sharp break lower? I do believe that it's because the strong retracement we are seeing these days in metal prices. Australia is a huge exporter of base metals, and metals have been plummeting this week. So everything is conspiring for further declines in the year. And so that's the level I'm watching, 70 to 10, 71.15. If a pair breaks below 71.15, I do believe that there's scope for a test of the 0.70 threshold. Not probably before the year end, but closer afterwards. Okay. And to the upside, the immediate short-term resistance is around 72.60. Okay, that's the level I would like to see the pair to recover to confirm an upward corrective movement up to this 3330 region, which is the 50% retracement of this year decline. That's the level I'm watching towards the upside. If the level holds and the pair fails to regain it, then again I will be looking for a plumb towards the 0.70 figure in here. I'm not following much as usual goal for OC behavior, but more copper and iron ore. Not that I trade metals, not that I like to understand metals, but at least I follow prices because if those two fall, right, you don't need to trade them, you don't need to analyze metals. It's enough to take a look at the charts here and there and see whether the prices are rising or falling to get close on direction for the Aussie dollar. Okay. Uh, what can I say about the Japanese yen? The market has took some profits out of the table, but it's back to neutral weekly basis after 6 weeks of steady advances. As we always said, when this particular pairs gets into a trend, you will hardly see retracement corrections or anything against the dominant trend, and the pair will probably keep going and going and going, like here, where we're extremely over both daily basis and weekly basis, right? And there we are still in around 18. Anyway, I don't see much of a pullback going on near the Bank of Japan. As I said earlier, has hopes Trump would solve most of its self problems, and a cheaper yen will probably help to boost consumption and exports, and therefore push inflation higher, which is what the Bank of Japan desperately needs these days, right? Inflation remains subdued, and no matter how confident Kuroda is in his speech, sorry, the fact is that inflation is well far below their target. Anyway, we have been as high as 1866 last week, so that's my first resistance. I believe that if somehow we take that level, the pair can go up to 120, while corrective movements, right, can go down to 116.20, okay, which was December 12th high, without really harming the bearish trend, and will probably attract buyers on dips towards this level, but beware that a break below 16 could see the pair falling another 200 pips without actually hurting the trend, but those 200 pips will be quite significant, with 114 as my main bearish target. And as I said about this one, the 120 threshold is next, okay? That's there. And gold, I have been following gold these days within this descendant channel. Uh, Pretty accurate, pretty clear. I do believe that we mentioned this multiple times. Uh, the bearish momentum is decelerating because we are getting closer to production costs, but that does not mean that the trend has meet bottom or that it will reverse. Okay, I still see the commodity bearish. I do believe that there's room to fall further and test 1050 region, right? Uh, but it will be slow motion. I don't believe that we are going to see much more recoveries in here. Anyway, going back to for our charts, I do have some highs in the 42.50 region, right? Not only from this last few days, but only from way above last year and before. So 1142 seems a tough resistance now. And if somehow the commodity manages to recover above it, we can see it running up to 48.49, which is the roof of this channel. Okay, if the roof is broken, then I believe we have scope to test 65.70 as a correction, but I'm not seeing it much higher than 80, right? And I will try to sell against this level, okay, against 82, 83. And of course, towards downside, this low at 1122 is my first support. Around below that, 1100 seems the next possible bearish target and route to dimension at 1050. Okay, that's what I'm seeing. Gold still bearish in there. Not not seeing much of a recovery. Uh, what's going on around oil, it's uh, not that clear for me these days. But what I have to mention is the fact that pullbacks right after the sharp gains we have seen with the OPEC and non-OPEC countries coming to a deal to cut production, right, has pushed price beyond, okay, the upper end of its latest range. Can draw a line around 52, and you will notice how many times the price has stalled and retreat from that level. It was also a major support back in 2015. And what this chart is telling me is that despite there's not that much confidence that the OPEC won't lie about cutting production, because that's what the market believes. Uh, at least oil analysts are saying it's not the first time the OPEC says it will do something and won't afterwards. But anyway, uh, the price is holding above the upper end of its range of this level that contained rallies for since mid 2015 and all through this 2016. So I have to say that my take here is bullish as long as 51, 52 keeps attracting buyers. Okay, that's a sort of line in the sand. Yes, we can draw it back down to 50. Okay, if somehow the commodity breaks below 50, then possibility of further gains are denied, and we may see a corrective movement that could take it back to 45, 44, 60 price zone. Okay, and in what I'm also seeing in these shorter term charts is that somehow 53.60, 53.90, okay, is the level to break to talk about further gains over the upcoming days, sessions, whatever you want to call it. And above that level, we can retest these highs in the 550 region. So, and keep that in mind. Uh, a strong rally beyond 55, levels like 70, 80, 90, or 100 are still for me out of the table, right? There's something I can't see. The commodity may go up to 60 in an ultra positive scenario where the OPEC actually cuts prices, cuts production, and uh, I don't know, we have trouble in producing countries that reduce further output, US stockpiles fall. Okay, there have to be several um, factors helping the commodity breaking beyond this 55 region. Okay, that's it. Okay, hey, I believe that's it for today. Thank you guys for being here. Hope I was useful. Hope this helped us with something. Okay, and sorry. Okay, there we are. See you back next week. Okay, we are going to have a brief comment, but I don't expect much action for this last 2 weeks of the year. So remember, in fact, I believe action will resume on January 6th, which is a Friday, and we have payrolls. Okay, so don't bet too much on action these days. Thank you and see you. Bye bye.